Hi, welcome to this video. So I'm going to show you a trade which I took yesterday by selling cash secured puts on CELG. And the purpose for doing it is to collect premium while I'm waiting for the stock to come down to the price I want to buy it at. So let me first give you a bit of background. CELG is a stock that I want to own for the long run, right? It's a great company. It passes all my fundamental criteria of a great company that is undervalued, that has got upward momentum. So this is based on my value momentum investing course, where I select great companies to invest in for the long run. So you can see that CELG is now on a clear uptrend. It was on a downtrend, as you can see, and it recently reversed trend, finding support at these moving averages. So you can see the price is above the 200 moving average, and the 50 is above the 150. So it looks like there's upward momentum. It's a great company, and I was looking to buy this stock. So the current stock price as of yesterday was about $85, right? 85.72. And I'm a bit greedy. I like to buy it at a lower price as a value investor, holding it for the long run. So I want to get it at about $82 or $83 there, about somewhere there. All right, is where I like to buy the stock. So again, currently the stock is here. I like to buy at a bit of a discount because I know in the long run it's a good company. It's going to go up in the long run, but in the short term it's going through a bit of a sell-off because of the recent market volatility. So I'm taking advantage to buy at a discount. Now, I could I could place a buy limit order at 82.50 and hope that the price comes down and I get to buy it at the price, or I could wait for the price to come down. So instead of doing that, I decided to make some money in the process. So what I do is I sell put options, right? I sell a put option at the strike price which I like to buy the stock at. In this case, I sell a put option at a strike price of 82.50. Now, again, you have to understand a bit about options. If you don't, please watch my introductory videos to options. Okay, once you've watched it, you understand how options work, then you understand it. So remember that when you buy a put option, you have the right to sell the stock at the strike price. But when you sell a put option, you are obligated to buy the shares at the strike price. So by selling the put at a strike price of 82.50, what does it mean? It means that I'm obligated to buy the shares at 82.50, which is what I want to do in the first place. Okay, so by selling these puts, I collect a premium. So what is the premium I collected? Well, you can take a look at my app over here. I actually did it on Interactive Brokers. So let me just scroll down to show you the trade. CELG. Yeah, that's the one. Just open it up. Okay. Scroll down. So you can see that these are the CELG 82.5 put strike. So it's a put option with an 82.5 strike price, expiring on the 18th of April. So it's expiring in about 30 days. These put options are expiring in 30 days. Okay. And I sold it for a price of, let's see, what's the price I sold it at? That's right. So I sold it at average price of $4.99. So this is about $5. So basically, by selling this put option, I collect $5 in premium, okay, per contract. So again, one contract is 100 shares. So $5 times 500, times 100 is $500. Or in my case, $499 to be exact. Okay, so by selling the put option yesterday, I get $499 credited into my account. So it's kind of like free money. Okay, now of course nothing's for free. By getting this money, I'm now obligated to buy the shares at $82.50 before or on the expiry date of 18th of April. So what are the different scenarios that could happen? Okay, so let's imagine right now the stock price is at 85.70. Now if the stock price goes up, or goes sideways or goes down but not low enough, it doesn't go below the 82.5 strike price, what happens? What happens is that I don't get to buy the shares. The put options I sold will expire worthless in 30 days. And what happens is I get to keep the $499 premium for free. So it's like I get free money. Now, of course, the only catch is that I don't get to buy the shares, right? But you know what I could do? I could 30 days later sell another put option to collect another $500. And I keep repeating the process every month, collecting $500, getting free money until the share price drops to the strike price where I'm obligated to buy the shares. Does it make sense? Okay. So in other words, if the stock price doesn't go down, it remains where it is or goes up, I keep the premium every month. If the stock price does drop way below the strike price and the options are in the money, what happens? The person who bought the put options may exercise the put options, which means they have the right to sell the shares to me at the strike price. And I'm assigned the shares, which means I'm obligated to buy at 82.50, which again is what I want to do in the first place, right? So if I'm obligated to buy the shares at 82.50, how much would it cost me? It will cost me 82.50 per share times 100 shares, because each contract is 100 shares. Got it? So it would cost me $8,250 to buy the shares. So I have to ensure that when I use this strategy, I must already have the 8 grand in my account, the cash waiting to buy the shares. If not, you don't do this, right? This is only used if you have the cash ready to buy the shares. Now, but although it will cost me 8,250 to buy the shares, remember, I've already collected $500 in premium, which means my actual cost of buying the shares will be 8,250 minus about $500. So I get a discount for buying the shares, and the actual price I get, actual price I pay would be $7,750. There you go. So you can see that by selling cash secured put options, it's a win-win scenario for a value investor. I can't lose. I win in every scenario. Does it make sense? So I repeat again, right? If after I sell these puts, the price goes up, the price goes sideways, the price goes down, but not below the strike price, I don't get to buy the shares. But I keep the premium, and I can keep repeating this process every month, collecting premium until I buy the shares. If the share price drops below the strike price, what happens? Then I'm obligated to buy it at 82.50, which is what I want to do in the first place. But I get a discount because I collect $500 in premium to offset the cost of buying the shares. Now, this technique is widely used by the biggest options trader in the world. Guess who that is? Warren E. Buffett. That's right, Warren Buffett. If you read about Warren Buffett, he's a value investor. He buys great companies like Coca-Cola. But when he wants to buy shares in a company, he wants to buy it undervalued because he knows in the long run it's going to go up, right? But he doesn't just wait for the shares to go down to the price. What he does is he sells put options, like what I'm doing, to collect premium, getting free money until the shares go down, and he's obligated to buy it. Sometimes you can keep collecting premium so much that by the time the shares come down, you're buying the shares for free, right? You get free shares or you get a big discount. And so I say to myself, if the world's greatest investor is doing this, why don't I do this myself as an investor myself? So again, this is only for value investments that you're holding for the long run, and in the short term, you're collecting free money to get a discount off the shares. Really cool strategy, right? Now, another reason why I sold the put options is because currently options are expensive. And by selling expensive options, I collect rich premiums. So how do I know that it's expensive? Again, take a look at this over here. You can see this is based on yesterday's statistics. The current IV percentile for CELG is 97%. That's really high. So in the course, remember what I taught you. When the current IV percentile is above 50%, it means implied volatility is very high, which means the market is very volatile. And when a market is volatile, options are expensive. So that's when you want to sell options to get premium and not be a buyer of options. All right. It's kind of like in hurricane season when things are volatile, what happens? That's right, insurance premiums are high. Okay, same thing here. So we want to sell options when there's a lot of volatility in the markets to collect good premiums. Now, some of you could be thinking, hey, I don't have 8 grand, 100 shares, 8 grand is a lot of money, right? Then no problem. You can do this on lower price stocks. Of course, if you've got more cash, you can do it on higher price stocks. But again, you only do it on stocks that are fundamentally good companies. You've done your fundamental research and you're investing for the long run and you believe in the company. This is not for short-term trading, it's for investing, right? Now, there's another stock which I want to buy because, again, it's a great company and it's undervalued. And this stock is JP Morgan, the biggest bank in the US, all right? So I'm going to show it to you. JP Morgan. Let's look at the charts right now. Now, again, this is more of a longer term investment. So if you look at the 5-year time frame using weekly candles, you can see that JP Morgan is a great company and the stock is always on a strong uptrend. But again, the price doesn't go up in a straight line, right? Prices go through retracements during volatility, right? So it goes up, pump retraces, pump retraces, pump retraces. And again, notice that every time it retraces, it finds support at the moving average. So these are great times to buy stocks of good companies. So you buy here, you buy there, and you buy there, right? Okay, so I'm looking to buy JP Morgan again. I bought the shares, I sold it at a high price, I want to buy it back, okay? Because I think it's getting cheap again. So currently, JP Morgan is trading at about 102 as the current price as of yesterday. But again, I'm greedy. I like to buy it somewhere here, right, at a cheaper price. I like to buy it at about $95, for example, right? 95, 94 bucks, somewhere around there. So again, what could I do? I could place a buy limit order and wait for the price to come down, or I could get paid for waiting. So I could sell put options, right? Sell cash secured put options with a strike price of $95. And again, when I sell the put options, what happens? I collect free money. I collect the premium, right? I collect the premium. Okay. Now, have I done it yet? Not yet. Now, why haven't I done it? Well, because it's not ideal to sell put options on JP Morgan right now yet. So I'm waiting. I may do it in the next few days, but let me explain why I've not done it yet. First of all, if you look at the option statistics, okay, so when you use options, you must always look at the statistics. Very, very important, right? And again, we look at current IV percentile. It's only 27%, which means that options for JP Morgan are low, they are cheap, and it's not worth selling them. You want to sell it when it's high, then you get more money, right? So I want the current IV percentile to be at least 40 to 50% to make it worth my while. So right now it's too low. I'm waiting. When it gets expensive, I'm going to sell the option. So again, you have to know when to do it, right? That's number one. Now, if I were to sell the 95 strike put options today, how much would I receive? Let me show you how much I'll get, which is not a lot. So I'm not really interested yet. So I'm going to go to option chain. And I'm going to look at the put options here. Now again, I usually like to sell the put options with a 30 to 45 days expiration date, which means in 30 to 45 days, it will expire worthless and I get to keep the premium. Okay, and then I do it again. I sell another option, expires, I keep the premium. It's kind of like insurance companies. What do? Right, every year they sell you insurance on your car and you keep paying them those premiums, and as long as you don't have an accident, they keep getting free money. Bastards, right? But we can do the same thing with this, right? All right, so if I want to sell, I'll sell the I could sell this one. Yeah, this one. So this is the one expiring on the 18th of April. 41 days to expiration. So that's the ideal one to sell the put options. Now, again, I like to sell the put options at a 95 strike price. So the strike price is 95. And what's the price right now? The market price is 75 cents. Yeah, not exciting, right? So if I sell, I'm getting 75 cents per contract. So that's multiplied by 100 shares. One contract is always 100 shares. So I will receive $75. Okay? So to me, I'm not really excited because 75 bucks, it's not enough. It's not worth my while, all right? So one reason why it's so low is because, again, the IV percentile, as you saw, was very low. Number two. Second reason that it's only 75 bucks is because if you look at the stock chart, you can see that the current price is 102, right? And I'm selling the put options at a strike price of $95. So the current price is still far away from the strike price, which means that these put options are quite far out of the money, and so you don't get much money from them. You only get 75 cents. So it's not worth it to sell it yet. So I would like to hopefully wait for JP Morgan's price to go lower in the next few days to maybe $100 or go down to $98. And when that happens, guess what? The 95 put strikes would be worth more because they'll be closer to the current price by the time. So by the time if I sell it, I could get more than $75. I could get $200 or $250. So usually for me, if I don't get at least 200 bucks, I'm not that interested. So what I've done is I've actually sold the 95 strike, 95 put strike with a minimum $2 limit, which means that it's not filled yet. Only when the premium goes up will I get the order filled. So let me just show you my order. It's over here, my account. Okay, go to orders. There we go. So that's my JP Morgan. That's my order, right? So the current premium is now 125. Oh, it's actually a bit higher. Well, because it's a May one. So okay, I'm selling further out of the money, further out of expiration. Yeah. So I'm selling the 125. Currently it's $125. Not good enough for me. I like to make at least $200. So that's my limit price. So if JP Morgan goes down in price, the value of the options will go up to $200. Hopefully, I'll sell it and I'll collect the 200 bucks. So once I get the 200 bucks, again, what happens? Once I collect the $200, okay, if the share price goes sideways, goes up, goes down a bit, but not below 95, what happens? I don't get to buy the shares. Done it, but I get 200 bucks for free. And I keep repeating the process every month until I get the shares. So I'm getting paid to wait for the shares to come to me. But if the share price drops below $95, then I'm obligated to buy at $95, which I want to do anyway, right? So again, it's a win-win situation. It's called cash secured puts, and one of the powerful strategies that I use in my investing.